Welcome to ESGX Live, the show for education and information to inspire collaboration and action. And it has been quite a week. There has been really so much that's happened in the world of sustainability in the last few days that it's almost hard to keep up. Coming up, we have a discussion about the parts of the Global Handbook for Impact Investing, and in particular, climate investing. And just as we get going, please do introduce yourselves to each other and us in the chat. Tell us where you are. Tell us things that you're particularly interested in, and we will try to cover them. And indeed, if you have questions, then please do cover those too. Just as a really quick recap, there was a discussion earlier today hosted by America is All In, talking about some of the initiatives now underway around the country and indeed all the way from at a national level down to a community level. I know we've talked before about the amount of money flowing into sustainability. I've shown this same slide with several different headings, but the point is these pies are getting larger, over $50 billion of net flows into ESG funds last year alone, which is quite extraordinary. Again, in the last week, we have seen Honda commit to complete electrification of its fleet by, I think, 2040, and hopefully quite a lot more before that. Just coming up, we have, as I say, the Global Handbook of Impact Investing. But before that, we will turn to our regular Green Jobs Report. So with that as the introduction, let me hand over to Paul Herman to introduce today's discussion.
Thank you, Nigel. Great to have that update globally, and Nigel will dig in deeper later in the program as well. I'm Paul Herman here in San Francisco. It is a sunny day outside, as well as in my background. And delighted today to have you with us. Please share with your networks the free online esgx.org. Today we'll be focusing on climate action, investing, and innovations with special expert guest authors from the Global Handbook of Impact Investing. So if you don't have yours yet, this is what it looks like, the Global Handbook of Impact Investing. It's 1,300 pages, bigger than War and Peace. But there's more peace than war, and you can set that up for your portfolios. And we're going to dig down deeper into that, talking about green transition bonds with Pauline Deschryver, with climate impact bonds with Joe Puri, and on fossil-free portfolios with Chander Balakumar. But before we dig in, we're going to do a Green Jobs Report. This will be 10 minutes or less. And we're going to cover what's happened the past year under COVID and take a full year's view at that. So I'm going to welcome Amir Khaleghi from the University of Missouri, Kansas City, and the Global Institute of Sustainable Prosperity. And Dr. Fadhel Kaboub is on as well, who'll join us later in the program. And of course, you may be following him on Twitter. Amir, you have detailed analysis of what's happened with green jobs the past year with details from the Bureau of Labor Statistics. So tell us more.
Right. So within this month's report, we're going to be able to see a 12-month review from February 20 to February 2021. And just making sure you guys can see my screen. Okay, so this is for our April Green Jobs Report. As always, our Green Jobs Report measures the direction, momentum, and changes towards a greener, more sustainable economy. The way that we do our analysis is that Paul and his team at HIP Investor provides a catalog of companies that have associated human impact plus profit ratings, which these ratings are based upon the company's performance, products, management practices, which include metrics on health, wealth, earth, equality, and trust, with a focus on people, planet, and trust. These companies are then mapped to industries based on their NAICS description, which is an identifier used by the Current Employment Statistics Survey, which is a survey that is conducted by the Bureau of Labor Statistics. So once we link these companies with their various industries, we then use an employment weighted averages to associate industries with their varying HIP ratings. So these HIP ratings will measure the greenness of industries, and there will be varying greenness throughout the economy. So highly rated industries there's bullet points examples below of the various industries within each bucket, but a highly rated industry would have a HIP rating from 50 to 75. Medium rated would have 25 to 50, and low rated extractive industries would have a rating of 0 to 25 HIP score. So just comparing the 12-month levels from February 2020 to February 2021, greener rated industries have been the most resilient to the COVID-19 crisis, while the extractive industries have had the highest proportional job loss. Looking at this graph here, it's comparing the levels within each bucket to the February 2021 level. And we can see that extractive industries have almost lost double the proportional jobs as compared to greener industries. And at a more granular view, month to month, looking at, from February 20 to February 2021, we can see the month-to-month percent change in employment for each human impact plus profit bucket. And what we have seen is the extractive industries have displayed consistently the highest proportional job loss throughout the pandemic. So looking specifically at March to April, that's when we saw the lockdown occur and 20 million jobs were lost within the US economy. The change from April to May and May to June, we saw the most significant return of jobs. But since then, our recovery has been slumped, as seen by the declining line from June to ultimately December, when we were losing employment again. But some quick facts, right? Our total employment is at currently 121.7 million, but we are still around 8 million jobs below the February 2020 level. Thankfully, though, we had a slight trending down from November to December, but we are showing stronger job growth, indicated by the change from January to February of 780,000 jobs. And something to remember too, when we're looking at the 20 million jobs lost from March to April, extractive industries and even slightly extractive industries lost a massive proportion more as compared to green industries. We're seeing here 18% for extractive industries, 15% for slightly extractive industries, whereas green industries have around 7.8% reduction, less than half of what the more extractive industries were experiencing. And then if we're looking at the graph as well, it remained the most stable and less volatile towards job loss throughout the entire pandemic. But switching gears for a moment, looking at the specific industries across this month's change, we have this new feature slide of top gainers and top losers for each of the industries. So looking here at the top 4 gainers of the month, we have restaurants with the most significant gain of around 275,000 jobs, an increase of 2.95%. And when looking at the top losers, we have our exterior contractors, which are contractors dealing with concrete foundational work. They lost around 36,000 jobs, or around 3.95%. When looking across the table, if you're looking at the rightmost column, you can see the associated HIP scores with each of the industries, and for both of the tables themselves. But something to be noted, right? These are, even for the losers, this is the highest losers for the month, and even still, very small as compared to the change from November to December. So very positive return as compared to the last few months. We're getting an uptick again. So that's also indicated by if we were to look at the change in initial employment claims.
And Amir, just to chime in for a second, that human impact and profit score or rating, that's the roll-up of companies in that industry. So like in nursing care facilities, you might say, oh, that looks quite low. And from the HIP rating, and one of the contributors to that is the pay might not be as strong as it could be, or the sustainability of the facilities might not be as environmentally sensitive as they could be. Whereas in delivery services, some of those companies might be treating people or planet in a stronger way. So this is part of the methodology, is to roll up the combined behavior of the companies in those industries and match who's gaining or losing, and who's more resilient, both on pay as well as on jobs.
Correct. And even specifically into the nursing care facilities, if you guys had joined us before, we did a deep dive into the healthcare system and how a lot of the occupations within the pay or within the healthcare system had to do with ensuring the payroll and ensuring the payment system of the healthcare facilities, rather than the progressing the health services of the health industries. But just as Paul said, ratings, they have a bunch of pillars, from sustainability, management practices, and all the things listed before. So it is a very dynamic rating in and of itself. And one of those ratings are the products and services. So looking at this year view of the products and services pillar, which is one of the pillars included within the human impact plus profit rating. Specifically, it just measures the net beneficial versus net extractive products and services that a industry provides. So a net beneficial products and services would be that of 50 and higher. And then net extractive would be that of 50 and below. And what we can see here is that looking at the month to month change, we're looking over that same period of 20 million jobs being lost, right, from March to April. Because of the distributions of the ratings in the products and services, we can see that there was a significant drop across all products and services. But interestingly, if we look at the quick facts box, the recovery of net beneficial products was much faster and much more significant as compared to the net extractive products and services. Excuse the typo there on the net beneficial production and services. It's supposed to be products and services.
Amir, that red line is even more volatile up.
Yes.
Down. So that's one of the key aspects of sustainability. And when we talk about impact investing, is it's not just the resilience of losing less, it's the lower volatility.
Correct. And yeah, not only the volatility with the red line, right, just swaying up and down. If we even look here, there's even a huge proportion or a huge reduction, even compared to the slightly extractive. The most extractive jobs, they're losing their jobs, and they're not even coming back, right? Like minus 17% as compared to the February 2020 level, as opposed to now. So very interesting. We can see both, products and services and HIP scores overall. The greener industries are not as volatile and more stable, and have significant recovery as well. So all great qualities to have within those industries, not only being net beneficial in products and services, but also being more resilient. And as we get to our next slide, paying significantly more. We can see here that the greenest most industries pay significantly more as compared to net extractive. Looking here, it's almost like a margin of over $10 per average hourly earnings. So yeah, so per hour. And looking here from the change from January to February 2021, greener industries saw an increase of 12 cents over the same period. Slightly extractive or medium rate industries saw an increase of 7 cents. And then the extremely extractive industries saw an increase of 6 cents. But still, I think the important note here is that if you guys have been following us consistently, greener jobs have paid more. But not only that, looking at the year in review, we can see how they're also more stable and more resilient. So it's kind of a no-brainer on why we are advocating for a shift towards more of these types of jobs. So as a final portion, I guess as a note to more of the, I guess, evidence or factors of resiliency for higher HIP rated industries is that we mimicked a analysis done by the St. Louis Fed, which measured the losses of high contact and low contact industry sectors. And what they did was take the occupations from the OES descriptions and link them with the industries. And definitionally, high contact industry sectors would have occupations which requires work to be within 1 arm's length. Therefore, they cannot socially distance. Low contact industry sectors contain occupations which do allow for social distancing. When comparing the absolute amount of employment levels from February 2020 to February 2021, we are around 5 million jobs below the February 2020 level for high contact industry sectors and around 2 million below for low contact industry sectors. But interestingly, yet
Amir, just a quick question. Joe Puri, one of our panelists, wants to ask a follow-up.
Oh, perfect.
Go ahead, Joe.
Thanks very much, thanks very much, Amir, and thanks very much, Paul. So, quick question. I think it'll be also useful to know the profile of each one of the industries or the averages of the industries in each one of these categories, because as you go forward and think about employment ratings and how employment is doing, it is important to see as to whether this is correlated or whether there's some causal relationship. And the first step of doing that is to also know as to what the profile of these companies is in each one of these buckets. So having a profile of that would be also useful to know as to whether there's just some exogenous factors that could be explaining both low variability as well as high jobs, right? Thanks.
Thank you. Thank you for that. And yes, definitely wanted to do deeper dives as we've created like a base knowledge level for our report. We've been wanting to do deeper dives within our own bucket levels and showing the companies that consist of it, but also with the updates of HIP scores coming out, it's going to be more beneficial to see the changes in buckets and being more dynamic rather than the only changes being within the CES. But yes, thank you for that input, and definitely something that we intend on doing in our future reports. But so in the high contact and low contact industry sectors, when deviating them from below 30 HIP score and above 30 HIP score, we found that a key takeaway that was even in high contact industry sectors, greener jobs remained more resilient to job loss when compared to extractive industries. When comparing the below 30 and above 30 for high contact industries, there's around a 2.8% difference, with above 30 HIP scores being more resilient, whereas the low contact industry sectors, the same, I guess, trend or attribute was displayed for industries that were above a 30 HIP score, with around a 3.3% difference between that of below 30 HIP score and that of above 30 HIP score. And with that being said, that is the end of my portion of the report. Thank you for those of you who have been joining us or those of you who are just joining us, and really excited for the panel discussion that is to follow.
Yeah, and just to answer a couple of questions in the question box. Green jobs in this context are the roll-up of companies in an industry based on their treatment of people, planet, and trust, and mapped to the Bureau of Labor Statistics data. So we're taking the best available data on sustainability and the most granular available data from the BLS in the US. And what that means is, Chris asked a question in the chat box, could we compare competitors in their job losses or not? There's not always comprehensive reporting by those companies of the leaders or laggards. So what we have found over time is that sustainable companies generally have a higher shareholder value over a 5-year time period versus lower rated companies on their sustainability. We are able to show that, solar and other renewable industries, Chris, can have stronger job growth and stronger pay versus some fossil competitors. All right, so let's pause it there. Want to welcome Amir, thanks very much. And thanks for the monthly Green Jobs Report and a full year view. I want to welcome Elsa de Morais Sarmento, the co-editor of the Global Handbook of Impact Investing. So feel free to get your copy. It's available globally at Wiley, as well as different booksellers around the world. Elsa, welcome back. Great to have you for our global webinar on impact investing, including our focus on climate action today. So how would you like to ground our discussion today? And we'll get ready to ask a poll as well. But what are you excited to cover today in climate action investing?
Hello, everyone. It's a pleasure to have you here. We have 3 main topics to cover today in this webinar. The first is about investment types and tools to advance climate action. The second part of the discussion will focus on how to reduce portfolio risks and spur positive outcomes. And the third part will be about the role that structures play in achieving transparency and possibly accountability. So these are the 3 main topics which I'll cover. Please feel free to ask any questions in the chat boxes, and we'll be interacting as we go along.
Great. So let's get started with a poll. There's 2 questions in this poll. So Nick Gower, our producer, will launch the poll. And the 2 questions are these. So today, when you are you applying climate action investing in your investing? Are you doing it in your investment policy statement, or IPS? In any investment criteria like greenhouse gas emissions? In any portfolio reporting that you're producing or receiving? Is there any storytelling around climate action? Or are you not yet applying? So feel free, this is multiple choice, feel free to click as many as you like. And the second question is that you invest in climate action in your portfolio. Where are you doing it? Are you picking only banks that fund renewable energy and don't fund fossil fuel? A lot of the big banks still are exposed to the fossil fuel industry, for example. Are there community development financial institutions, microfinance, business loans? Are there bond funds or public equity funds? Real estate or other asset types, including venture capital and private equity. So please fill in your answers. They're multiple choice. Check as many as are relevant. This was really great when we did this during the Gender Lens Investing webinar, which there are 4 chapters on gender lens investing in the Global Handbook of Impact Investing. And we'll give it a couple more seconds. And then Joe and Chander and Pauline, please join us. And Nick, you want to total them up? So here come the results. So at least half of you are using it in your investment criteria. So this is criteria of what goes in the portfolio. So please feel free to put in the chat what that metric or that filter is. A third of you actually are doing storytelling, and slightly more than a third of you are not yet applying. So that's why you're here today, to learn how you might do it. And it's great to hear that a handful of you have actually built this into your investment policy statement as well. So that's on part one. On part two, in terms of where it's happening, a third of you are saying it's happening in your banking and savings. So you're at a sustainable bank, maybe a credit union, also a community development financial institution. We'll talk about those. Looks like the majority of you who've answered, equity funds is one of the top answers, and venture capital in about a quarter of that. And then about a fifth of you in your bond funds as well. And then there's other asset types. So curious to hear, please tell us in the chat box, what are the other asset types that we haven't covered here where you're doing climate action investing? All right, very helpful to have this sort of point in time review and feedback from everybody. So we want to welcome our panelists. Pauline, you want to introduce yourself and tell us about, also your thoughts on green transition bonds, and then Joe, and then Chander.
Hi, Paul. Hi, everyone. Thank you for having me. So I am Pauline Deschryver. I am an investment officer for a development finance institution focusing on the infrastructure space and with the geography of Africa and Middle East. And my background is in sovereign advisory, strategic consulting with a focus on Africa, and green and sustainable finance, both in academia and in financial institutions. So regarding the first question you asked, Elsa, so about the investment types and tools to advance climate action, I will mostly focus on fixed income products, which I'm more familiar with. So first, green and sustainable bonds. They are the most common instruments in this space because they have been issued now around 15 years. The first green bond has been issued in 2007. And we have public and corporate insurance. So in the public insurances, we have at the national and the subnational level. At the national level, we have seen France, Germany, but also China, Fiji, Nigeria in Africa being the first issuer on the continent. So you have many examples. At the subnational level, it's still nascent, but we are seeing this space in development with cities like Paris, Johannesburg, or Mexico issuing their green bonds or sustainable bonds. And we have also multilaterals like the World Bank, EIB, IFC issuing their own green bonds. And corporates are also issuing this type of instrument. In Morocco, we had the bank BCP. We have also big players like Unilever or Apple in this space. So I won't spend a lot of time on this one because it's quite, I think our public knows it already, but it's good to start with them. Second, we have a transition bond. Is where I focus on this product in my chapter. So it's this instrument is really in its infancy. So far we have only 3 or 4 issuances, one from an oil company, a utility, and a beef producer. So for a transition bond is for a company, for issuer which cannot qualify for a green bond because of his profile, his activity, but needs to transition to green a part of his activity or to transform his business model. And so we are seeing this. This can be very attractive for some issuers and also for some countries that have an economy based on oil. I am thinking, for example, about Nigeria or South Africa, for which this instrument could make sense. And the third instrument I want to talk about that could be very efficient to advance the climate agenda is sustainable or SDG or KPI linked bond. So contrary to the other bonds, you don't have a specific use of proceeds, you don't have specific projects, but you have KPIs linked to environmental or social metrics. And it's measurable, it's very specific. And you have a very critical incentive to go green for issuers because your pricing mechanism is based on what you have promised to the market in terms of development of renewable energy or greening your activity. So I think this instrument can be very, very efficient. Thank you.
And EIBs are environmental impact bonds, so they usually have like performance metrics on them. Is that right?
Yes, yeah, and they have issued also. They have I don't remember if it's EBRD of EIB, but they have also defined transition bond in their own way, so which is really interesting. We are seeing many definitions, so sometimes they are not really aligned, but at least there is a lot of momentum and a lot of, I would say, enthusiasm about this space.
Great. Yeah, and you've done an in-depth job in the chapter in the book, the Global Handbook of Impact Investing. So appreciate that deep dive, Pauline, and helping envision what the future can look like. So Joe, how about you? Where are you now and what are you focused on, and what does the landscape look like?
Thanks, Paul. So I'm Joe. I am the Director of Environment, Climate, Gender, Nutrition and Social Inclusion now at the International Fund for Agricultural Development, which is in Rome. But when I wrote the chapter, I was working at the Green Climate Fund as the head of the Independent Evaluation Office there. And as you can imagine, a large part of my personal and professional life and mind is occupied by thinking about, first about impact, but also the second part is, and that's very close to my heart, is really thinking about real impact and washing and the dangers of washing. And so this is exactly what I write about in the chapter that's co-authored with two other colleagues of mine as well. And but I'm happy to talk about it when we come to that part of the question. I think the first part of the first question really is to think about what is the landscape and why are we so excited about climate impact bonds and what are the possible instruments that we can use, and how we can use these instruments to advance climate action. And Pauline, alluded already to climate impact bonds, to bonds that are related to KPIs and sustainability and resilience bonds. And the key thing is really tying these to greater assurance of benefits with respect to climate. I have concerns about that, but for now, I'm going to put away some of my concern there to point out two important things and then give you an example. First, when we are thinking about climate, it's not just about mitigation. And this is one of the things that I think is really important, right? Every time we talk about climate mitigation. How many tons or 1,000 tons of greenhouse gas emissions are we mitigating or reducing or sequestering when we are, say, growing trees? But climate action has to be about adaptation and increasing resilience as well. And this is what resilience bonds are trying to do. They are trying to increase the resilience of communities and societies on the ground. But increasing resilience is can be postponed to, say, 100 years from now when greenhouse gas levels actually reduce, but it can also be linked to adaptation and resilience today, which means that we are building the resilience of communities today. And you can do that by reducing volatility, uncertainty, and improving the livelihoods of a lot of the people that you're trying to impact. International organizations have a special role here because they can come in as agencies with hopefully lesser conflict of interest. And I use that word, with a huge amount of humility and without malice at all. But I think the other part is also ensuring that we are actually seeing those impacts related to climate adaptation and resilience on the ground, and but also mitigation as well. So reducing greenhouse gas emissions. One very quick example of this is really what is being innovated. And again, a lot of the impact bonds that we are seeing in the area of climate really follow from the social impact bonds, the development impact bonds, etc., that you're seeing. They follow the same contractual structure. But I think the interesting part is when you have to think about risk transferring and in large regions. So let's think about the Caribbean, and this is actually pretty nice work and some things that we are thinking about as well. We know, for example, the entire Caribbean insurance premiums have increased by 10 to 40% in just the past 20 years. And parametric insurance is good, but it has high basis risk. That is, it does not cover full loss and damage. Because climate change is a regional phenomenon in the Caribbean, risk cannot be pooled. But countries can reduce risk by increasing their resilience. That is, and in the long run, this leads to fewer claims and eventually lowers the cost of underwriting, which eventually leads to lower premiums. So this is essentially the idea of resilience bonds, resilient securities with equity that is also being thought about within the Caribbean and many other areas where you have to pool risk and you can't transfer risk. I'm going to stop here. I'm hoping it's whetted your appetite. Happy to talk about it more. Thanks.
Yeah, and definitely curious to hear more about the equity measures, or both how to facilitate it and how to track it over time. So we'll come back to that, Joe. Okay, well, Chander, welcome. Thanks very much for your contribution of the fossil-free investing chapter to the Global Handbook of Impact Investing. Joe wrote about climate impact bonds. Pauline wrote about green transition bonds. You wrote about fossil-free, or is it possible, or should there be any fossil companies in a portfolio? So tell us more about that, because it's it's a little bit, it could be controversial to some people.
No, happy to, Paul. And how I approached the chapter was first looking at China as a case study. And that's just because China is is the world's biggest green market maker, as well as one of the world's biggest polluter. So it kind of fills this dichotomous niche of, being innovative with the most green solutions, but at the same time being one of the biggest polluters in the world. And kind of looking at how they handle their own investment decisions alongside their policy, and seeing if it's being more investor driven or policy driven, or if it's a combination of both. And I think, as we all know, it's most usually a combination of both. And from there, I take a look at emission-based metrics in terms of how do we measure emissions across a multi-asset class portfolio, and how can we quantify that to say to mitigate fossil fuels exposure, like Joe was talking about previously, and looking at if that's feasible or not. And at the same time, not just looking at scope-based emissions by themselves, but doing that in tandem with ESG. Because you could have an impact-based portfolio that's geared towards fossil fuel reduction, but if it doesn't take into consideration ESG metrics, then you're losing the whole case of ESG risk. And I think there's this connotation in the industry where, especially in alternative investments, when they consider ESG risk, they don't consider it as part of business risk. And that mentality does need to change, where ESG is not additive, but it's already inherent in a business. So looking at all facets of fossil fuel reduction, across these three areas, I then try to look at example investments across different asset classes to say, well, these would be a best practice investment in this asset class, anywhere from weather derivatives and hedge funds to private equity examples of what a suitable portfolio company would be that meets your fossil fuel free reduction mandates across. And then ultimately, I propose a solution of, perhaps a fossil free portfolio is ideal for Main Street investors, but for Wall Street investors and big institutional asset owners, we're not at a state where that's fully possible or fully realizable, just because of poor asset class diversification, and the accounting for scope-based metrics isn't at the place where it needs to be for investors to fully implement them in their investment decision-making process. And we'll get into more of that later on. And yeah, I'm excited hearing Joe and Pauline speak. It's definitely going to be a multidisciplinary approach that is the solution. So looking forward to contributing that. And thanks for having us on here.
Thanks, Chander. I have a quick question for Pauline and a comment on your chapter also. I was wondering, Pauline, whether how can these transition funds really be something that is able to grow and expand, or we just expecting to see within a very limited short period of time with just a very few examples? So to what extent they can be scaled up as other industries come along and want to become greener. A quick comment on your chapter, Chander. Your chapter is called Fossil Fuel Free Investing, Weaving a New Investment Paradigm. And you review the motivations that drive investors to adapt fossil fuel free strategies. China is, as you've said, featured as the main case study, which is quite compelling because it shows, as you mentioned, both the power and limits of public sector approaches to clean energy development. Actually, Beijing is hosting since 2016 the International Institute of Green Finance at the Central University of Finance and Economics, which is an independent nonprofit think tank. And China is actually the huge market with the huge demands for energy and is also a powerful example of how renewable energy subsidies can reduce and replace fossil fuels with clean energy technology. What we know is that in the latest 14th five-year plan, China committed to carbon neutrality by 2060, along with grounded level ozone pollution, climate and other energy targets, which is a remarkable commitment to achieve the Paris Agreement. However, despite these commitments to very ambitious anti-pollution targets, they did not promise to reduce total energy consumption from non-renewables and even left the door open to increased coal output. So there's also the need to really see these policies as an integrated whole across not only energy policy, but also environmental protection, climate action, and I would say even circular economy. So we need to have an integrated view in order to be able to also prepare the economic fabric to come up with bankable green projects. And we also need a taxonomy, which is still, I believe, being developed, and I know that the World Bank has produced some knowledge material on that. And then we need to get the financial sector behind it. So I think there are still some, but just a lack of synchrony between ambitions and what is happening on the ground. So perhaps we can go to Pauline first.
Regarding future transition plans, I think
the sound is not very good. Can you check your mic?
yes, can you hear me?
It's a little bit robot-y. Maybe Chander can answer first, and Pauline, you can.
Chander, over to you.
Oh, can I get that question again? I was kind of focused on Pauline's answer.
No, it's just commenting on China and the level of ambition compared with actually the possibilities that we see of actually achieving those commitments.
Mm-hmm. No, and I think that makes a great point. For my research in the chapter, what I found was that China is leaps ahead of us in terms of innovation in that field. If you look at the number of patents filed annually in terms of green energy technology or green tech, they've been substantially higher for China versus the United States, for example. And at the same time, when you look at the subsidies, one of the interesting points that I found is that China is subsidizing their green investments, but it's doing it at such a rate that their fund is actually running a deficit. And so to meet that deficit now, instead of increasing taxes, they're just cutting the funding for projects. So solar energy products now are under more scrutiny in China, just because they have such a big multitude of green energy products that they've already funded. In terms of, policy in China and, how they're doing it right, it's a great idea in terms of, encouraging these investments through subsidies. But at the same time, when you look at the other side of what China's been doing in terms of their Silk Road infrastructure projects in resource-constrained countries and developing countries, it's essentially outsourcing their fossil fuel-free production in the way that they're not fully accountable for it because it's happening in those other countries, but they're still reaping the benefits of it because the energy is being shipped back to China, either through coal and other fossil fuels. And it's something that's directly reported. It takes a lot more research and deep dive into actually figuring out what their actual numbers are. But it's something to keep in mind in the sense that, just like how companies hide things in their balance sheets, countries are capable of doing the same thing. And I think to measure innovation with progress, I think true adoption of the UN SDG goals needs to occur for companies to report according to these. And that's where I stand right now, is just, promoting the adoption of the UN SDGs, getting countries on board in terms of a uniform framework for reporting. And the SDGs do a great job of doing this. I think what we're lacking right now is just that disclosure, that transparency, that third-party verification to say, these figures have been fact-checked and I can approve it. Pretty much a country-level audit, if that would be possible, would be where we need to be. But yeah, that's touching on a lot of different things, and I don't want to take anyone else's time, but yeah.
I saw that perhaps Joe had something to say.
Yeah. No, thanks, Chander. I think you sort of stimulated, and Elsa caught my body language very quickly. But it's really important to think about exactly the things that you're thinking about. We've got experience in exactly what, in MRB systems or in forestry projects. This idea of leakage has been recognized even 20 to 30 years ago. Yeah, the idea that you can invest on carbon sequestration in one part of the world, but really be dirty elsewhere, and essentially, just displace your activities from one part of the world to the other. This has been recognized, and what I'm really keen to also push forward is both the roles of not just states, and that's what Elsa rightly pointed to, but also of international organizations, because I think they have to be the mediator, the honest brokers of paradigms such as these, right? To set up systems so that we can really verify. But I think the call that you're making and that Elsa is stimulating and provoking, thank you, Elsa, is really to think about how is it that we can verify and ensure that these things are not just displaced and these things don't just leak. And that's why having really good metrics on this is really, really key. Otherwise, we go into washing very quickly. Thanks.
Pauline, let's try your mic again.
Yeah, try again. Can you hear me now?
Not quite.
Can you hear me better if I am speaking like this?
Yeah, Pauline, either if you have like a mobile device, maybe try and access it from that possibly, or drop and come back.
Yeah, maybe logging off and on.
There's like a roboticizing of your voice somehow. Sorry to say. Yeah, so this measurement, reporting, and verification, Joe, how do we get like accurate answers from that from the field? Are sensors helpful? Do satellites help? Like, what are the technologies that actually ensure a higher quality?
Thanks, Paul. But so just to back up a little bit, it's not that we lack the technology. It's that we lack the incentive system. We have the technology, we have the data, we have the sensors, we have the satellites, we have all of that. We've had it for a while. The question is, who guards the guardians, right? Who sets up the system so that we will actually go and measure and verify and report? Because currently, and again with malice towards no one, what we do have a lot in the green sector and in the climate sector, etc., is that agencies and stakeholders that are responsible for doing the work on the ground are the ones that are responsible for reporting, and there's no verification. There's no third-party verification of that. And unless you have that third-party verification, which is independent, and Pauline, are you here? Good. And independence is used in a very, very strict sense of the word. It's not that the issuer is then paying the verifier to go out and then verify and report back, because you've got a conflict of interest immediately, and that happens a lot, right? In system after system that we've looked at, and this happened even with pollution reporting, something very, very simple. People who are supposed to actually report on pollution outputs are paid by the companies that are polluting. So that has been going on for about 40 to 50 years. So it's really important for us to take a very fresh look at where are the conflicts and how we can set up really independent verification systems. But it really goes back to the incentives that we have within our contracts and how these contracts are set up. And so my chapter actually talks precisely about that. How do you set up these contractual systems and the incentives for different agencies within that contract to really take it upon themselves to own the results and to own the impact? And that has to be really defining the system as we set it up. And we're at that formative stage right now, right? we're setting up the system. If we don't do it right now, we won't do it. And then we'll be essentially held hostage by the fact that we are grandfathered into it. Thanks.
Pauline, over to you. Let's try your sound again.
Can you hear me now? Can you hear me? Yeah, good. All right. Sorry, apologies for this glitch. So getting the future of transition finance, I think the priority would be there because of risk and because also of opportunities. Physical, they are regulatory, they are transition, but
the connection
there
is
is also a
breaking.
huge investment opportunity. I refer to reports.
Pauline, one more thing.
Yeah,
Maybe
turn
off
of
the
investment
video.
opportunity for city. We can see there is some.
Yeah, Pauline, if you turn off the video, I think that should work finally.
Okay. Can you hear me?
Yes.
Can you hear me?
Yes.
Okay. So I was saying that because of the risk, but also because of the investment opportunity, the need to transition is key, but the models will differ. And so in my chapter, I talk about the bonds, but I think it's an instrument quite polemical. We have seen it with when we had the issuance of Mafrec, for example, the investor community was quite divided about this issuance. But so we need to, the instruments will have to be defined. The only priority will be how to transition. So we'll have to innovate, to create products that can really support this transition. And as Joe was saying, metrics will be key. I refer to the guidelines by ICMA regarding the sustainability linked bonds, which need, when they define the KPIs of these products, they say they must be material, quantitative, predetermined, ambitious, regularly monitored and externally verified. So we see the stringency regarding KPIs, and this is going to be increasingly the case. And this will build transparency, and we need transparency for the transition, but we also need simplicity because my fear is having too much complexity. And without some clarity, it will be difficult to transition properly. So I think we need also to have guidelines, to have a language that can be easily understood by all the stakeholders in this space.
Excellent, thank you. Any other comments? Anyone? So I think we can move on to the second question. How can one reduce portfolio risk and spur positive outcomes? Who wants to start?
I can go. So for my fossil fuel free lens, reducing portfolio risk was all about reducing your exposure to fossil fuels. And the most adept way to do that is looking at your fossil fuel exposure for, let's just say, your public equities based on at a sector level, an industry sector level, rather than just as an asset class. And I say that because it doesn't become apparent, but your tech companies aren't going to have the same type of emissions that your energy utility companies are going to have. And another important point in that is, there's this prevailing sense that, when you build a fossil fuel portfolio, you automatically have to get rid of your energy utility companies that are fossil fuel based. And that might be fine for your 401k portfolio or other Main Street investors, but for big institutional asset owners, that's simply not possible. The asset class diversification isn't there for them to be able to do this. So when looking at energy utilities in a fossil fuel free portfolio, your objective isn't to eliminate fossil fuel exposure completely, but rather it should be about maximizing your efficiency of fossil fuel use. And that's measured by increased energy productivity. And that's pretty much saying how many more goods or products can you produce with this level of energy use than you could before, while also minimizing fossil fuel use. And this is important to note just because in the industry for energy utilities, a complete divestment from these energy utilities will lead to stranded assets, poor asset class diversification, and just, sorry, I kind of blanked there. the issue of like a worker shift. So where are these workers going to go if they all of a sudden leave the energy utility sector that's producing the majority of our energy use? So from that standpoint, it's more important to just efficiently use our fossil fuels that we are currently, rather than completely eliminating it. We as a society have come this far from unadulterated fossil fuel use, and to suddenly say, just be cut off isn't quite feasible. And the solution is just, isn't just a simple cold turkey of fossil fuels. It's a gradual process of weaning off fossil fuels and transitioning into green energy. And I think that's where the transition bonds come into play, where increased reporting, where increased framework adaptation comes into play as well. And I think as time progresses, we can actually eventually have the conversation of, well, I'm a big institutional asset owner and I want to be fossil fuel free. And we can have that discussion, but currently it's just not possible. There's just not enough diversification. There's just not enough assets to put money towards to have that happen. But yeah, in terms of risk reduction, I think what you need to look at is, are you reducing your emissions portfolio wide? And at the same time, are you doing that in tandem with ESG? And I think that's how you reduce your risk in an increasingly climate challenged world.
Yeah, I just want to ask a quick question though, Chander. That's quite controversial. And Fadhel, you might have an answer to this, or Joe, you might have an answer to this. But BlackRock just launched this carbon transition readiness fund with $1.2 billion in it, and it has Exxon, and it has Chevron, and sure, Jeff Ubben is on the board now of Exxon. They're not doing anything to stem the carbon production that they're doing. So how is that lower risk or acceptable risk for an investor? That seems kind of controversial.
Yeah, so I mean, I'd have to look at the IPS statement for how the fund is managed. So, but for me, my perspective, my own personal investing, how I look at when I invest oil companies is, I go look at their sustainability reports or their annual reports, and I look at their scope 1, 2, and 3 emissions, and I'm looking at whether is that going down year by year, and at the same time, is their total energy mix leaning towards more green energy than the traditional fossil fuel. And I think a good example of that is Equinor, a utility company based in Europe. They're very transparent about how they're, putting forward these new initiatives about transforming their energy mix from just fossil fuel based to more green energy based. And the level of investment they're making too is transparent in their reporting. And I think if you have utility companies that are, adapting these frameworks, being transparent, and we need to, as investors and as, members of society, we need to encourage the transition rather than say, well, you're doing this, so we're not going to invest. But rather say, I want to put my money where the future is, and I want to help you transition to a more greener future. And then what Nigel has pulled up right now is just the differences between the scope-based emissions in terms of collecting scope-based emissions. So scope 1 emissions in the chart deal with direct emissions from activities under a company's direct control, such as if you use a company car or fleet. Scope 2 emissions measure the indirect emission as a result of purchased electricity in the upstream activities of a supply chain, like the heating and cooling required in large warehouses. Scope 3 are indirect emissions. They're often the least reported and the most difficult to calculate, but they measure the emissions associated with the product life cycles from upstream all the way to downstream activities in a product's supply chain. And another thing to point out is, there's companies that automatically report this, or not automatically, that willingly report this already, but the adoption isn't quite there yet on an industry or sector-wide level for meaningful comparisons to be made of all companies. And some of the ones that are already voluntarily reporting this do it through NGO partnerships, including the Science Based Targets Initiative or the Carbon Disclosure Project. And though the rate of participation is increasing, the lack of reporting regulations is preventing investors from fully vetting a company's fossil fuel risk. And I think that's that's the current landscape of what we're seeing.
Yeah, these are 3 important organizations to keep track of. Chander, thanks so much for mentioning it. Science Based Targets Initiative, and that's a combination of 4 nonprofits, including CDP and World Resources Institute. So they're tracking the 600 or 700 companies who have goals like 100% greenhouse gas reduction by 2030, like Stanley Black & Decker does or Novo Nordisk does. Some of them are on track, some of them are behind. Carbon Disclosure Project, which 20 years later, has done an amazing job for voluntary reporting. They're doing that on cities now, as well as on companies. And then the Sustainable Stock Exchange Initiative has dozens of stock exchanges in their requirements for reporting. So the one last thing I'll say is the US SEC says that all material risks must be disclosed. And as of 2010, that includes greenhouse gas emissions. And greenhouse gas emissions are a material risk. But the SEC to date has not required those greenhouse gas emissions reporting. So A equals B and B equals C, but A does not equal C. So we'll see if that changes under the Biden administration. Fadhel, thanks for just a report to everybody. We're going to go past an hour, might go an hour and a half. This is being recorded, so if you want to share that, if you need to leave, we're recording the session. We've already have private requests to send it because they want to share it with their staff or boards or trustees. So we're going to continue going deep on this. Fadhel, is there anything you want to say about how these get financed? And then Joe and Pauline, feel free to jump back in as well.
Well, a couple of things I want to say before I go into the financing. Well, I'll say one thing about the financing. There's substantial need for, Green New Deal type of investments by countries like the US, Japan, Canada, countries that have plenty of fiscal spending capacity and don't really have an inflation constraint, especially right now. Countries in the global south definitely need assistance. And I've talked about it in the form of climate reparations, colonial reparations, other transfers of technology and financial resources, which I will not discuss today. But I wanted to pick up on the climate risks that are embedded in every portfolio. If you're an endowment manager, a pension fund manager, climate risks are already lurking on your balance sheet as we speak. The stranded assets, there's two types of stranded assets that we need to distinguish here. There's stranded assets that we're continuing to build today, knowing for sure that there will be stranded assets at some point. But then there's the stranded assets that were built 20, 30 years ago that still have a life cycle to go. Those stranded assets, I'm okay with getting the most out of them as we transition. But the new stranded assets that we're building right now, that is not due diligence, if you're a fund manager and still investing in those. And it's not me saying this. I think the SEC is going to soon come up with some more aggressive regulatory changes in this front. Right now, the SEC has a 90-day open period for comments on this specifically. The Federal Finance Housing Agency in the US also has a 90-day open period looking at climate risks related to real estate properties, because insurance companies and financial institutions are not going to insure coastal properties and at risk of fires and flood properties. As we speak, this is not in 20 or 30 years. So this is happening right now. The Federal Reserve Bank has a climate change committee, and there will soon take more aggressive action on this front, including on disclosure and reporting. But there will be some green monetary policy coming at a central bank near you very soon. The ECB is right now hiring a climate change director that will probably be the #2 person at the ECB. All major central banks are already panicking about these climate risks that are building up within the financial system. So yeah, this should have been done 20, 30 years ago. But I think now everybody's hitting the panic button after the IPCC report from a couple years ago. Immediately after that, you saw the BlackRock report, you saw the JP Morgan report. All of those reports are saying those IPCC guys are actually optimistic. It's much worse than that when you look at the embedded climate risks. So the good news is that there will be some action soon. The goal for us is to design a system that's multi-pronged, that allows us both on the fiscal policy, government regulation, macro prudential regulation front to really accelerate the green transition and create those incentives. One of the things that regulators can do, and the Basel Committee, by the way, is also looking at this. The Basel Committee has a climate change committee, and they're looking at capital adequacy requirements. Because if your buffer for financial collapse is your capital ratio and it's packed with climate risks, then we're really not protecting financial institutions or financial markets. So one of the things that could potentially happen is that the capital adequacy requirements that central banks and regulators impose on financial institutions will be split into green versus extractive capital adequacy requirements. And this way you accelerate, you make green investments more attractive, more resilient by definition, and you open up a whole market for green bonds, impact investments, resilience bonds, and so on, to accelerate the financing in the global south, but also here in the global north, because most of these portfolios are in Europe and the US and Australia. So there's lots of things that can happen immediately to accelerate this. Central banks who have been implementing stress testing since the 2008 financial crisis are now designing models to do climate stress testing to figure out which financial institutions will withstand the impact of these stranded assets that we're talking about. So all of these things are being invented as we speak. And I think we're going to see some serious action on this front in the next couple of years at the most, because the clock is ticking on this front. And then the floodgates are going to open for pulling financial resources that I hope will be utilized in the most impactful way. And I agree with you, Joe, earlier, that it's not enough to decarbonize. We have to build resilient infrastructure. We have to mitigate these risks because, to be honest, it is already too late to decarbonize and say we can fix this. At this point, we have to do both, accelerate the decarbonizing efforts, and at the same time build resilient infrastructure in cities and coastal areas, and invest in regenerative agriculture, and stop the commitment to investments in areas where we know we're going to simply create more and more stranded assets moving forward.
And I can see Joe's got a question, but I'll just jump in with one quick comment, which is, even in Australia, which has been a laggard in a lot of these issues, you have got both some very high profile billionaires who are investing their money to drive action. And at the other end of the scale, the federal government is now beginning to commission analysis on carbon markets and pricing regimes, etc. This is not widely advertised, but the RFPs are being posted in the public domain. So there are signs even in Australia that I think perhaps some more significant action is coming, which is great to see. But Joe, you had your hand up, so go.
Well, thanks, Nigel. Thanks, Fadhel, for that. I wanted to come in on a couple of things, and both in response as well as in comments. So 3 points, I think. As we all do, over the weekend, I read the Europe Gas Tracker Report 2021, because of course, this is what we do over our weekends. Okay, so this report, Fadhel talked about stranded assets. Basically, the EU is going to be increasing its gas import capacity by investing, by essentially creating $87 billion of stranded assets, which will lock in emissions well beyond 2050 and will do nothing to them reaching their 2050 target and the 55% reduction that Europe is promising. And this is all fossil fuel based gas, right? So even as we are making commitments today, and we are going up to COP26, we are making those investments today. Forget the ones that were, that were invested in 2015. I think I'm a little bit more compassionate about that. But I think the big crime is occurring today as we are thinking about investing today in assets that are essentially going to govern the way we live our lives for the next 50 years. So I think and this goes to the question that has also been posed by some of the attendees on the chat as well. Who guards the guardians, right? And I think so. There's a two-pronged answer to that. Definitely, I think governments should take a far greater leadership role and a far more brutal role. I don't think the private sector is taking on that role, BlackRock or not. I think there's a lot of, even though there are commitments being made and letters being sent to investors and directors on one side, you do find, exactly like you said, Paul, a lot of the portfolio that is actually being invested on is actually very much oil and gas and fossil fuel. So I think you've got to then have governments taking on the cudgels, but you've also got to have international organizations. If you go back to the Depression, the 1930s depression. Before that, and a little known fact is that we did not have standardized ways of understanding health of companies in standardized financial reporting mechanisms. It's only that the recession made us far more vulnerable and made us realize as to how the absence of standards and an entire cohort of chartered accountants who could actually audit our accounts in standardized ways and help us to compare companies, that changed the way we started to look at companies. That time is today. 1930s and now 2021, we've got to create that cohort of that discipline that will go back and look at how credible we are in the impacts that we are claiming for climate. We've got to create that cohort, and the investments have to be done by, organizations that do care about the global public good. So international organizations should be held to bay. The third point I wanted to make, apologies for the rant, but really important, there are companies that are willingly reporting, but there's a selection bias in those companies that are willingly reporting as well. They are the ones who are doing it, and they are the ones who can report it, and they have the capability to do it. But it's not those. So just that we have to be concerned about the biases that we are building into our own thinking systems, right? When you look at investments, you look at the ones that are reporting, whether they're being green or not, whether they are proofing themselves for climate risks, etc. But you've got to look at the dogs that didn't bark. And I think that becomes really important as we think about setting up these systems. Thank you.
If I may, I want also to add that I think we should change the narrative, because when we talk about climate investment, we tend to only focus on the risks, while there are many investment opportunities. And this is challenging also the paradigm of conventional finance, because normally in finance, the higher the risk, the higher your rate of return. But as we have seen, is that with green products, you are reducing your risk and you increase your profitability, and you have also positive outcomes. Also, Amir at the beginning showed that jobs in green industries have been more resilient to COVID. Recently, data in Morningstar showed that ESG funds have better performed than normal funds. And we have seen also an acceleration during COVID. So we may think it's only on the short term, and we need to be patient to have more data over the long term. But I see it as a proof of we need to change the narrative and to see the opportunity in that space. And to answer your question also, Elsa, how we do that, to how we reduce risk and we spur positive outcomes. You were talking, Joe and Fadhel, also on resilience. There is another instrument I wanted to bring is a resilience bond. So it's about physical risk because you are really focused on adaptation and resilience. So you are specifically allocating the capital to projects that increase resilience to climate change. So they provide financing for projects that aim to increase resilience, but at the same time, they provide a certain coverage against climate-induced disasters. So they are not however, of course, as a life insurance, they are not reducing physical risk, but they reduce the financial consequences for asset owners. So it's another instrument I wanted to mention that allows to do both. So we have to be innovative, and we may not have to choose.
I wanted to address the point of government intervention. So that was the thought that came to me in terms of, well, why isn't the government doing more in terms of, pushing towards a fossil fuel free world, just because, it is beneficial to their citizens, tax-paying citizens, especially when you look at all the health outcomes of poor health choices and, increased death rates from pollution. And what I found striking in my research was that the fossil fuel subsidies haven't gone down in the last 5 or 10 years, but in countries, they've actually gone up. So to me, I read about, these new commitments, we want to reduce our emissions by, set percentage by 2030, 2050. But then when you look at spending on fossil fuel subsidies, it's going up year by year. And then a report, I think, as an example, Canada spends close to more than $3 billion a year on fossil fuel subsidies. And the International Monetary Fund estimates close to 6.5% of, global GDP is being used on fossil fuel subsidies. So I think my question is, how do we fix this disconnect between, what countries are saying and versus what they're actually doing? Because we're seeing that in Australia too, like Nigel mentioned. I think last year in 2020, Australia was in plans to open up multiple new coal mines, and they just had a year of wildfires, and it's very counterintuitive, and it seems like there's there's this prevalence of simple bottom line investing that's still pushing the markets, and an old guard that's not willing to let go, because there's this connotation that impact investing and ESG investing doesn't allow for above market rate returns, and that's simply not the case. And like Pauline pointed out, the ESG funds outperformed their non-ESG counterparts this year by a substantial amount. I think even at HIP with all our strategies, especially our fossil fuel free strategy, we did exceedingly well. I think from our Q2 rebalance to Q4, we were up more than 26%. And for me, I'm not sure who the players are. What is the definition of the old guard? But how do we get governments to actually move their money towards a greener future?
Chander, very quickly though, I do like to keep us honest on this one thing, right? Just because you see high returns coming from ESG firms does not mean that because you're an ESG firm, you're seeing high returns. That causality is something that we should not push unless we can actually test it. And actually, there's been really good work done by a couple of authors that I can point you to as well. But so on one side, I think we're asking the world to be honest, but we've got to keep ourselves honest with respect to causality and correlation. So that one does not mean the other. So thank you, sorry.
No, completely agree. And no, just like my stats professor used to tell me always, causality doesn't equal. So I appreciate that, keeping me in check.
Yeah, and that is the whole raison d'etre for the HIP investor approach, which is precisely to address that challenge. One thing I was going to say about Australia is it is all political in that there is no support from the investment community for these projects. There's no support from the banking community, even in Australia. So some of those, it's being pushed by government, but it is an increasingly uphill battle. On the other side of the ledger, talking about who the old guard are, one of Australia's oldest old guard companies is Adelaide Brighton, an old industrial company, and that has just started a process to experiment with decarbonising its lime and cement production using Australian technology. And I was delighted to see that development, and also thoroughly surprised because it is an example of a company that has been a real slow mover on anything to do with the 21st century, beginning to take a different path. I think that's really encouraging.
All right, so we're deep in it. There's lots to do. There's lots to do in a short period of time. So as we begin to wrap up our session, Joe, Pauline, Chander, Elsa, Fadhel, what needs to get done? Like, what's a short summary of what should be next? So one of the questions is around COP26. Is that a helpful measure? So who would like to go first?
Okay, I can do COP26. COP26, so three things. The administrations that come to COP26 shouldn't just be thinking mitigation, they should be thinking adaptation and resilience. So that's number one. Number two, they should be thinking carbon markets and setting down the rules for it. And there's not been enough thinking. And frankly, I'm not sanguine about carbon markets just because we haven't heard anything in the chat box about carbon markets, and the time has come, the walrus said. And the third is we've got to push for far better standards on climate reporting that we're asking from companies than what is happening now. I was in my previous incarnation as well as now, I'm pushing organizations to think about leakages, general equilibrium effects, indirect effects that we are going to see as a consequence of our investments. So really verifying as to whether we are going to realize even those mitigation benefits that are announced with a lot of fanfare at the beginning, I think is really key, and we've got to hold ourselves honest. So 3-point agenda. Thank you.
Just a quick comment. I was thinking on, what goes beyond the role of governments. And I was thinking, we have initiatives such as the UN Global Compact. We have, I believe, 2 private sector initiatives that I believe are the only ones that exist, at least the only ones that I know that involve the private sector in this whole scheme of thinking, which is the United Nations SCAP, so the Commission for Asia, the Sustainable Business Network, and OECD has got also a private sector network. Well, I haven't thoroughly assessed it, but I'm told that the UN Global Compact is a major failure. And well, I don't know if you have more inside information. So I don't see also here how we can connect these dots fully. We for sure need also some push from the private sector side for more regulation, for more screening, for everything that we have been mentioning on the part of the public sector. We need to have international organizations to strengthen also their role and to push this agenda forward. And probably we need the whole ecosystem to be working together. But there are a lot of loose ends in here. So I don't have the solution, but I see these international initiatives such as the Global Compact with really the drive to do so, well, to do something and to get further. Just a quick thing.
Yeah, I agree, Elsa. I think the Global Compact and a lot of the Sustainable Development Network, I think, and a few others, and UNESCAP. So they do work to bring in the private sector. But again, I think what we are talking about, if I am to be really brutal, is that we've got to ask for more. I don't think that there's sufficient leadership right now in getting companies to be honest and really for ourselves to be honest in this space. And I think Fadhel said this as well. We've got to set up the incentives in the global system so that there is actually truth telling and impact telling in the right way, right? And I don't think that those incentives are in place yet.
Yeah, they're happening fast through capital flows, though, and that's causing a mix of both aspirations and competition and greenwashing and impact washing. So that's going to continue to shake out in the coming days, weeks, and months as capital flows. And as long as investors are true and not just buying brand names of what the fund's called, but actually what they're actually doing, that can help. All right, 1 minute wrap-ups each from Fadhel, Pauline, Chander, and then Nigel will bring us home.
I'll add one more line on incentives, just to not to end on a negative note, but the World Bank, which is not the tree hugging club, they're estimating by 2045, by 2050, I think 140 million people will be displaced, mostly in the global south, due to climate change. We're talking about climate refugees here. So the urgency for building resilient infrastructure in the global south and to build the resilient infrastructure in the global north, because many of the people who will be displaced will be moving to the global north, adding pressure on housing, on schools, on food supplies. We're not even close to being ready for mass movements of people at the scale that we're anticipating. So if there's going to be another item added to the incentives list, it's going to be the crisis itself, that we're not even prepared at that scale, and a lot of the people who will move permanently. I mean, some studies now are estimating that some parts of the world, especially the Gulf region and the Middle East, will be uninhabitable during the summer months at least. So those people will not move and come back in the winter. Right? So we're talking about millions of people moving because the climate in their region is going to be uninhabitable, which means the economy, which means the agricultural system, which means nothing will function, in this system. So are we taking this seriously and building the resilient infrastructure, identifying the financing mechanisms, and investing in research and development to produce the kinds of technology and the kind of circular economy that will allow us to survive and thrive? I don't think we're even close. I'll give you an example. The European Green Deal.
To wrap up.
I'll wrap up with just the European Green Deal, which is 1 trillion euros over 10 years. That's a drop in the bucket. And they're hoping that most of it will be financed by the private sector. I mean, this is not even funny, right? We're not even close. So I'll leave it with that.
Thank you, Fadhel. And Fadhel has many webinars on the Green New Deal. So encourage you to check that out because that is the systematized approach, Joe, that some of which you're asking about. Pauline, Chander, and then Nigel.
Yeah. I'm wishing for...
Oh, we're losing you again. I'm afraid it's the robot. Chander, why don't you?
Okay, sure.
Chander.
Sure, I can go. I think for me, what I've seen through COVID and other examples in history is that mass action doesn't take place until a majority of us are affected, either directly, and it has to be directly for us to feel empathetic to the cause. And I think for climate change, many of us, in inland states or even inland countries, haven't quite felt the drastic effects of, coastal regions moving more inward and just climate change refugees in general. And I think at the point where it does affect all of us, it'll become too late. And I think that's why we're seeing all this double talk in terms of what countries are doing and what they're actually saying. And so I think my point is, I hope it's not too late. I don't want to leave. I want to leave future generations without a planet to live on. But, it is a multidisciplinary approach because there is human psychology involved. There are the markets involved, and there is a huge systemic shift or paradigm shift that needs to happen. But obviously, I'm still learning about this as well. And I think we just need to keep having this discussion and moving forward.
Fantastic. Thank you very much. And should we have one last try in Paris with Pauline?
Yeah, can you hear me?
No, it's the robots are still killing you. I'm so sorry. Look, I know we're coming to the end, so maybe I'll wrap up very quickly. It's been, I think, a fantastic discussion, very broad ranging. And as I think someone once said, some people are born to sustainability, some people discover sustainability, and some people have sustainability thrust upon them. And we clearly need a very vibrant mix of those three things to happen urgently. Looking ahead very briefly to what we have coming up, or late in the evening on 4th of May or 5th of May here and everywhere east of New York, we have a special event, again, talking about impact investing, but with a focus particularly on the Asian region. And on the 18th of May, we then have an event talking about tomorrow's economy and with a particular focus on the global South and indigenous nations and whether inclusive and reasonable growth is even possible. Beyond that, we will have our regular Green Jobs report at the end of May, and we have a special event coming up on the 8th of June focusing on oceans. There may be one more in the middle. Watch this space. For the recording of today's show, you can go to our YouTube channel at live.esgx.org, or you will find it on our website a little bit later this evening. And if you're watching on YouTube or anywhere else, please do share all of this with your friends on social media. Please like the YouTube channel. That helps to broadcast these messages to a wider audience, for which we are all very grateful. And I think that's probably it from me. I don't know if you want to add anything, any final word, Paul. Otherwise, we'll wish you all a very good afternoon, good evening, or good morning for those who've got up early to join us.